the stock market and the different types of stocks. So, what are they? Well, before I begin, can you please click that subscribe button, like this video, and comment? It's great help. Now, for those of you who don't know the stock market, and I'm sure you don't, I guess, because you clicked on this video, well, try turn on the TV, maybe listen to the radio, surf the web, things like that, and you'll hear things like Dow Jones picked up 1%, 2%, went down 1%, 2%, and you'll think, what is that? And that's what we're going to be learning today. That's what I'll be talking about, the basics, the basic idea of what the stock market is. And I also get to the different types of stocks. Now, what is that? Well, the stock market, it's a place where you could earn millions and lose millions. A place where you could buy and sell stocks or shares of a company immediately and make some profit, maybe thousands of dollars. A place where you could basically become wealthy. A place where it's run by one simple emotion, driven by one simple emotion, which is greed. It's a place where a lot of greedy people, not greedy, but a place where a lot of people whose greed is on money, becoming wealthy, basically anything to do with money pulls in. People invest into something, buy and sell, bid and ask, all that kind of stuff happens in the stock market. So think of it as an auction. Auctions for money. That's what it is. Now, I'm going to be explaining two uses in the stock market. There's investing and speculation. Now, I too wonder, isn't putting money into the stock market investing? And it is. But again, there's two methods or uses. This is the two uses of the stock market. So there's two different types of people. One is investing and speculation. The other two is speculation. So investing, what is that? Well, think of when you look at a company like Apple, what do you see? Wow, it's a big company. You know that it's a multi-billionaire company making a lot of profit, making a lot of money, and it's selling a lot of phones, things like that. A tech company, that's what it is. But for example, why did those people who bought Apple back in the old days at $1.50 or maybe $2 buy it? So the reason why is because, well, they believed, they knew that the company is going to become bigger. They knew, some people, they knew what they were researching on so much that they were thinking that in the future it's going to become something big. So they invested a lot of money into Apple. And that's how Apple became financially, well, their capital has grown. So that's what investing is. And look at where Apple is right now. It's $500 per share right now. And if you bought $1,000 back then and waited out, it's $500 right now. That's basically a lot of money. So that's investing. So basically, people who invest have an eye in the future. They make a rational decision if this company is going to do well or not. And then they predict into the future if you could make money. So in the end result, people who succeed doing that make a lot of money. Think of Warren Buffett. He's the main example. Now, speculation. I don't really know what speculation is because I don't practice it. I don't even research on how to do it. Basically, you use your gut feeling. You don't really have to research. It's your gut feeling. They look at the stock chart or the chart of the stock market of a company and they look, hey, I have a gut feeling that this company is going to do well in the next few days, maybe months. And so they invest. They could lose money or they don't. So it's essentially a gamble. But the difference between gambling and investing in the stock market in general is the time frame and the amount of effort you put in. Basically, you wait it out if you make profit or not, and also before you invest, you use your knowledge of that subject or you research on that company if that's going to do well. So that's investing in speculation. Now, that's the basic idea of what the stock market is. I didn't tell you guys how to invest or anything like that. I'm going to talk about that in future videos, but I just gave you the basic idea of what the stock market is. Now, what is the different types of stocks? There's common stocks and preferred stocks. what are they? Well, before I talk about that, I have to tell you how a company is founded. So when a company is founded, there's the original founder and there's the early investor. Say there's two founders and one early investor. Essentially, the company's stock or share is split into thirds. Each person has an equal amount. So the two founders have 1/3 of the company's stock, and their investors also have 1/3 of the stock. So what does this mean? It means that the company is right now private. So when you hear that company is a private company, it means that the shares of that company isn't publicly traded. So it's pretty hard to get hold of a private company's shares. So as the company becomes bigger, the need for the capital expands. They need more funds. They need money. And also the early investors want to monetize their shares. They want money, so what they want to do is they want to sell their shares to other investors. So what they do is the company itself issues an IPO, an initial public offering. So that's how a company becomes a public company. The shares become publicly traded. When that company's share becomes publicly traded, well, there comes in the common stocks and preferred stocks. So what are they? Well, let's start with common stocks. Well, when people talk about the stock market, they're talking about common stocks in general. Now, common stocks give investors a voting right to elect board members, and board members, well, they decide most of the major management of where the company's headed, like the CEO and all that kind of stuff. So the people who have common stocks have voting rights, which elects the board members, and then that board members decide the major decisions of where the company's headed. So you get the drill, right? So that's what it is. But what are preferred stocks? Now, preferred stocks, they're not as common as common stocks, but they give out dividends, kind of like bonds. And, well, they are traded too, but they also give a monthly dividend. So people who have preferred stocks, they have monthly statements like, here, thank you for investing to us. Here, I'll give you $20, maybe $30. You never really know. It depends on how many stocks or shares you have, the shares of preferred stocks you have. So that's what it is. And also, people who have preferred stocks, when they need to liquefy their shares, people who have preferred stocks gets the first call. So people who have preferred stocks, well, they can liquefy their money first. So that's what it is, and I hope you guys liked it. Tomorrow, I'll be getting into what are IPOs. Now, for those of you who's been watching this up till now, thank you. So please click the subscribe button, like this video, and comment on your thoughts in future videos. What I should talk about, all that kind of stuff. Thank you.